The last time the banks did this, the world plunged into the global financial crisis. I'll show you why we're on the cusp of it happening again. Plus, tonight's show is brought to you by IPA Antibodies. You can find them on the NASDAQ under the symbol IPA, and they're a leader using artificial intelligence to revolutionize drug discovery. And the last time we featured IPA on this show, their stock went on to rally over 100%. And wait till you see the chart setup, you'll see why they're poised to make another 26% rally. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's turn to Hong Kong, where we find out why the bankers are doing something they did the last time we had a financial crisis. And right now, 25 billion pile of sour debt is spurring talks to form what's called a bad bank. Now, I want to understand why banks do this to begin with. The first reason they do it is they want to free up their balance sheet so they can lend, and they've got some bad assets they just want to offload. The problem is the Hong Kong banking system, according to regulators, looks pretty good. So that doesn't make any sense. The other reason banks do this is they know they've got a lot of bad assets. They want to get the loans off the book, because if they don't get them off the books and these were to go into insolvency and then ultimately to liquidation, what happens is you get price discovery. And this is exactly what happened going into the global financial crisis. All of a sudden, overnight, millions of people all around the world found out that the banks were holding insolvent assets. And next thing we know, the entire world plunged into an all-out crisis. So what we're seeing now from the Hong Kong banks is the exact same thing that led into the global financial crisis. And yet the discussions underlie growing concern among the industry insiders over bad loan buildup. Sour loans increased to 25 billion at the end of March, or about 2% of the total of a two-decade high, according to Fish estimates. That may climb to 2.3% by year-end, the biggest jump in Asia Pacific. But here's one of the key points. The loan quality is likely to deteriorate further through 2026. And why is that likely to happen? Is because the global economy is continuing to slow, and that means there isn't enough new money being created to pay on all of these old debts. So when you have a dollar shortage or a currency shortage in any economy, what happens is loan quality continues to deteriorate. What you see is delinquencies start to rise. They turn into defaults, and then eventually they get to liquidation stage. And that's the real risk here, because if a number of loans started going into liquidation, what we would find out is just the same thing we found out going into the global financial crisis, is that the banks are sitting on a lot of bad assets, far more than they want to admit, and that the entire system is illiquid. And this is really important as we talk about commercial industrial lending. We talked about this in yesterday's show, how it makes such a difference in the economy, because in a debt-based economy, you need new money created to pay on old debts. But when you see a deceleration, or even worse, a contraction in bank lending, what you start to see is delinquencies rising. And this is exactly what's starting to happen all over the global economy. The problem is, underneath every banking system around the world, as you're about to see, there's far more bad debts than anyone wants to admit. Let's take a look at commercial industrial lending, shown in blue. That's on a year-over-year rate of change against the delinquency rate for all commercial loans. Now, this is U.S. data here. And there's two things I want you to see. Let's go back to the late 1980s, and you can see that deceleration in commercial industrial lending that ultimately leads to a contraction. Now, the key point about contractions here is that is when money is destroyed. So when you don't have enough money in the system, well, you don't have enough money to pay on all the debts, and next thing you know, you see the delinquency rate rising. Now, this happens going into every recession, and you can see it very clearly, and we're seeing the early signs of it happening now. Now, the other point is, you'll notice during periods of expansion, when you have strong lending rates, what happens? The delinquency rate goes down, because there's enough new money being created, not only to support the growth of the economy, but again to cover up a lot of those bad debts. The delay by some banks in recognizing impairments has helped mask even weaker underlying asset quality. And this is all because the banks don't want to write down these assets, because then it means they're going to have to write down a lot more assets. And next thing you know, we're going to find out the entire banking system is insolvent. Again, this is a major problem, because the banks don't want this to happen, and there's nothing the central banks can do to solve it. If you think that quantitative easing or rate cuts will fix this problem, the issue is it won't. We know the Fed or any other central bank in this case is powerless to stop it. So the only move now is to offload these to what's called a bad bank and hope that the situation in the global economy turns around, or that the banks can offload them fast enough before the entire system blows up. But something we think is headed a whole lot higher is a stock for our sponsor for this show, IPA Antibodies. Again, you can find them on the NASDAQ on symbol IPA. And I want you to see that their stock is trading in this channel right now, and it broke out into this, rallied up, pulled back, rallied up again, and now pulled back and held this channel. This is a very bullish indicator, and based on the upper end of that channel and where price is trading today, on top of the fact there's rising momentum across this RSI and MACD, what it's suggesting is we could see a potential rally of another 25 to 26% to the top end of that channel. Again, you can find them on the NASDAQ on the symbol IPA. Stay tuned to the end of the show or check out the pinned comment or description for more information. And we should be seeing more distressed sales. It's a little alarming that we're not, and it's not alarming at all, because this is the issue that we saw with Chinese property developers. Remember, they were insolvent and they went to court because they weren't paying on their debts. And what happened? Investors came in and said, look, stop this. Don't let them go into insolvency here. Don't let this go to a liquidation sale. We'll fix this. Because what would happen if there was a distressed sale and all of these assets were written down? Next thing you know, the entire industry would have to write down these bad debts. It would spread all across the world, because the issue that these Hong Kong banks are facing, it's the same one that small and mid-sized regional banks here in the US are facing. It's the same one the German banks are facing, and banks all over the world. And it's commercial real estate. And the problem is it's lost a lot of value. Everybody's been trying to extend and pretend, but one day in not too distant future, we're going to find out the real value of these assets, and then we're going to find out the entire global banking system is illiquid. And now you're starting to see why these Hong Kong bankers are panicking and starting to offload this debt. And lenders including Hang Seng and Bank of Communications recently engaged with advisory firms and held early stage discussions about setting up a special vehicle to take their bad debt. And one of these proposed entities is modeled after China's distressed asset managers and could allow banks to recoup at least a portion of their loans. But the problem is a lot of banks don't want to do this because they don't have the cash on hand. They can't absorb the losses. And that's the issue, is when it's sold to a bad bank, what happens is this bad bank is either funded by money from other banks, or it's funded by the government, but the bank that's transferring that bad loan over, they have to take a haircut. The problem is, as we look around the global banking system, we see the banks are in absolutely no position to do this. It's a dangerous sign, one that's warning that we're on the cusp of another financial crisis. And the Hong Kong Monetary Authority said in a statement has no intention to set up a bad bank. Well, they would never admit that. But while Fitch predicts loan quality will continue to deteriorate, it has said the situation is manageable given that lenders have large buffers. And again, this is the same thing we heard going into the global financial crisis, that this was an isolated issue. The banking system was strong and robust. The Fed didn't really need to do anything except maybe lower rates. And if central bankers just did that, everything would be okay. And then we found out it was a systemic issue, and next thing you know, the entire global banking system froze up. But what is it that these Hong Kong banks are probably really worried about? Well, it's a slowing global economy, and even Fitch admits, at a rating agency, that things are going to get worse, and for good reason. Why? Because when you talk about delinquency rate, here again you see it in red for all commercial banks, it's all about unemployment, and you could see the relationship very clearly throughout history. When the unemployment rate goes up and people can't make payments on loans, next thing you know, you see the entire system start to seize up. And what did we hear from UK companies recently? That they're issuing profit warnings. And what does that mean? That their ability to pay on their debts is weakening. We know this is going to happen to companies all around the world. So we're seeing this stress show up in two ways, one at the corporate level, the other at the consumer level. And now you understand why these Hong Kong banks want to offload things. Of course, the monetary authority there won't admit the truth, at least not until it's too late. And while the valuation of commercial real estate in Hong Kong has likely fallen more than 50% in the past few years, they haven't really declined a lot on property companies and bank books since there has been few transactions. It's a big dilemma for both developers and the banks, because if these were written down, then developers wouldn't be able to get loans. They'd go insolvent. Of course, that means that they would be upside down on properties they built. Consumers wouldn't want to pay full price. but at the same time, they wouldn't be able to get a loan because the banks would all be insolvent. So you can see both sides are agreeing to keep things where they're at. Their hope is that some form of stimulus in the future, the economy will turn around and someone will pay full price or even more for these properties, and somehow things will clean up. But what you're finding out from these Hong Kong bankers is the reality is the global economy is getting worse. And let's turn to Germany, who we know is facing the same issue, and we can see signs that the economy continues to get worse as German car parts maker Bosch is now set to cut up to 1,100 jobs. And again, this is just the leading indicator of rising delinquencies and then insolvencies. The necessary job cuts are not easy for us, but they are urgently needed to secure the future of the site. And that's the issue that I think is going to be facing companies all over the world. As the trade war hits and the tariffs are set, profit margins are going to erode, demand's continuing to fall, and that means employers and businesses will be forced to cut. That means the unemployment rate likely to head higher, and with that, of course, the delinquency rate. And the evidence is clear as we look at this chart of the unemployment rate in blue overlaid against the corporate profits after tax in red. That again shown on a year-over-year rate of change. And you can see very clearly when the unemployment rate goes up, it's usually because corporate profits have gone negative and are likely staying that way for a while. Of course, companies forced to shed workers. Next thing you know, again, you start to see the delinquency rate go up. Now you start to understand the global economy isn't healing here, and that's the major problem. We're not seeing a big push of people going back to work. We're not seeing buildings finding their occupancy levels rising. And this is what the Hong Kong banks are worried about. They've got to offload these assets in a way that nobody will see if they go bad. The problem is what we're facing as the economy continues to slow is the signs are we're on the cusp of the next financial crisis. And if you don't think the U.S. banks will do this, well, watch out. You'll see. It'll happen. And Trump's trade war is taking the biggest toll on the nation's smaller secondary ports from California to the Gulf Coast. So as we continue to talk about the labor market weakening and demand weakening, let's take a look at what's happening around ports all over the country. The ports of Oakland, Jacksonville, New Orleans, and Panama City, Florida are getting sandwiched out of port calls as more shippers decide to offload their freight in larger ports in an effort to get their product in before the tariffs. Now, this is because demand's down. But look at this. The Port of Oakland recently reported a 10.1% decrease month over month. And when they talked to the director there, he said, quote, "This is not a seasonal dip, but a market recalibration." And the problem is you see these declines in demand. It affects the ports, but more importantly, it affects the workers there. And we've talked about how container volumes are a key economic and job driver for a port's local community and economic stability. In fact, the Port of Oakland supports more than 9,800 regional jobs. And the problem is this has also been an issue for larger ports. We've been talking about the Port of Los Angeles. And remember back in May, the director there said, we saw that for every 2 longshore members that walked into the hiring hall, 1 went home without work. So now you're seeing this lack in demand. And again, we showed you the chart where you see imports in the United States when they decline or even worse contract, the labor market goes with it. So you can see the reaction by these Hong Kong banks. They're trying to front run this trend in commercial real estate. The problem is we know there's a lot of distressed commercial real estate assets on banks' balance sheets all over the world. And I think 50% just could be the beginning of where we see these things written down. And if you think the outlook is getting better, well, it's not, because the outlook for Chinese exports into the U.S., according to recent data, suggests a decline in orders heading to the U.S. in the coming weeks. We can go back to earlier 2025 and we can see instances where they're front running the tariffs, and what happened afterwards, there was a big decline, and we're already starting to see that now. We've seen so far that the manufacturers have been eating a lot. We've been seeing a lot of retailers doing it, but a lot of retailers' margins got very fat during COVID, and this is a big problem because right now what you're seeing is these margins are getting eroded, demand is going down at the same time, they're going to be forced to lay off. Do I think the Fed needs to cut? Yes. Do I think it'll do anything? No, but the psychological effect here is important. But the reality is President Trump can't get rid of him no matter what he does, because it'll rattle the markets in a major way. But today we did get some good news on the Japan front, as we will now impose a 15% tariff on imports, including automobiles, from our ally, while WHO is also going to create a $550 billion fund to make investments in the U.S. And while that deal is now done, the problem is, again, you have 15% tariffs. These are going to get hit at companies across the supply chain, manufacturers, wholesalers, retailers, and ultimately we're going to likely see consumers bearing some brunt of this. The problem is, as the economy slows and we see consumers reject higher prices, what this is setting up for is exactly what's happening in Hong Kong. You're seeing more loans go bad. They're looking to offload them. The problem is, if they can't get rid of them fast enough and the economy deteriorates around the world at a much quicker pace, well, watch out. We're on the cusp of an all-out financial crisis. But something we are bullish on is the stock for our sponsor for today's show, Immunoprice Antibodies. Again, you can find it on the NASDAQ and symbol IPA. We'll take a look at that chart here again in a minute, but everything you need to know in the pinned comment and description below, because they've had a lot of announcements since they've last featured. And they're a leader using artificial intelligence to revolutionize drug discovery. Known as IPA, this tech bio company is pushing boundaries in healthcare with its cutting-edge LensEye platform, tackling major diseases like dengue and diabetes. And let's dive into why IPA is a company to watch and what's driving their stock to new highs. And they're a trailblazer in AI-driven drug discovery, blending biology and technology to solve some of healthcare's toughest challenges. With operations across North America and Europe, IPA's innovative platforms are catching the eye of the biotech world. And here's why they're poised for growth in a major way. Back on July 3rd, IPA announced a major breakthrough with its LensEye platform powered by patented HYFT technology. A new validation study showed LensEye accurately predicts antibody binding sites on 17 previously unseen therapeutic targets, achieving near crystallography precision without prior training data. This game-changing capability compresses drug discovery timelines and unlocks previously unreachable targets, positioning IPA at the forefront of AI-driven antibody therapeutics. And less than a week later, IPA strengthened its leadership by appointing John Lieber to its board of directors. With over 30 years of financial and strategic expertise in biotechnology, including roles as CFO at Rally Bio and other leading firms, Lieber's addition bolsters IPA's ability to scale its LensEye platform and drive commercialization. His capital markets experience signals IPA's focus on strategic growth and investor confidence. And then IPA announced it regained compliance with NASDAQ's minimum bid requirement, solidifying its position as a stable, publicly traded biotech leader. And then on July 21st, IPA appointed Jeff Fried, a healthcare visionary with over 25 years of experience, to its advisory board. As Director of Platform Strategy at InterSystems, Fried's expertise in high-performance data solutions enhances IPA's LensEye platform, enabling faster, more scalable AI-driven drug discovery. His appointment underscores IPA's commitment to building a bio-native AI infrastructure for the life science industry. And what this is doing is setting up the stock for a potential major move higher. Now, I showed you this channel chart earlier, and you can see this is a key point because the stock broke into this channel and rallied up, setting a top end zone. It pulled back, held support. This is creating a higher low. It rallied up, making a higher high. It pulled back again, holding support at the bottom of the channel. Again, a higher low, setting up now the potential next move of a higher high, and that could be upwards of 25 to 26%. And this is all in the back of rising momentum. And Immunoprice Antibodies is redefining what's possible in medicine with AI-driven innovation. If you want to learn more about this rising star in biotech, visit IPAtherapeutics.com to explore their vision and groundbreaking work, and be sure to check their stock out on the NASDAQ under the symbol IPA. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.